Come on, dog. Okay, come on. Good girl. Good girl. Come on. Hey, what's up, everybody? Happy Wednesday. It's a beautiful day where I am. My goodness. Love springtime. And no, I didn't run into a lawnmower. This is how most people go to the barber shop or whatever. I just take out a pair of clippers and shave my damn head. It's a lot cheaper than going to the barber shop. What's up, everybody? People were asking where the hell I've been. I've been doing some other work. I'm with the dog. I was doing so much stuff on TikTok. I was kind of neglecting some other stuff in life, which I've had to focus on. And the thing is, people accuse you of doing this for money and stuff. It doesn't pay anything. I think in all the 7 months I've been doing this, I might have made $1,200 or something. I don't know. It's just not much money. Not that I'm doing it for money. It's just we all have to make a living somehow. Anyway, a lot of people have been sending me messages saying, hey, are you okay? What's going on? So I thought I'd do a quick live. But I just want to let everybody know I'm not going to be doing as much stuff on TikTok. I'm trying to move over to YouTube and Rumble because I'm just kind of tired of the TikTok bullshit. Getting strikes on your lives, getting your videos taken down, all that same stuff that everybody else goes through. It's a pain in the ass. Yeah, well, a lot of people on the Zionist side, they when their lives go, they always accuse people who are pro-Palestinian of getting paid or something. I don't know of anybody on the Palestinian side that's ever gotten paid to do any advocacy work. Maybe somebody does, but I'm not aware of it. But on the Israeli side, I'm almost positive that people are being paid to come on here or other places and try to influence the narrative. It's what they do, because no one in their right mind is going to advocate for that for free, right? Snowing in Montreal. Wow, cool. Yeah, I love Montreal. It's beautiful, although I like it in the summertime a lot more than the winter. I got to check that out. Anyway, so I just want to let everybody know I've been working on trading, financial markets. Oh my God, dog. Are you eating a bone again, dog? Hey, don't eat bones. It's going to get caught in your throat and you're going to get, damn it. Yeah, people around here will eat like fried chicken and throw the bones on the ground, and then the dog eats the bones, and it's bad. But yeah, I've been working on some trading stuff. So I was wondering if anybody wanted to learn some of that stuff. I know it's a totally different subject than what we've been talking about. But it is interesting. It's not easy, by the way. Everyone thinks they can make money in the markets, but it's very difficult. But the good news is once you kind of learn what you're doing, you learn what not to do, which is the biggest part of trading, is not doing stupid stuff. And eventually it just kind of works itself out. You just kind of do it. It's a numbers game, though. But I'm just curious if anybody wants to learn the basics of it. I can tell you this. Most people do not listen to what I'm about to say. And if you're one of them, that makes sense. I was one of them, too. Because everybody wants to make the quick and easy money. They want to get in and make like tens of thousands of dollars and live this great. And it doesn't work that way. The way I can relay it to you is this. It's very simple. Okay, let's say you're someone who's just picking up golf. And we know that golf is a sport that's very hard to do when you first start. You're very awkward. But let's say that, usually you have to qualify for a PGA Tour event, the professionals. But let's just say they change the rules and anybody could come in. And so you're a new golfer and you have to pay an entrance fee of $5,000 to play. And then if you get a top 10 or something, you make more money. If you don't, you lose your money. So that's very similar to trading. The barrier to entry, anybody can get involved. As long as you put money into a trading account, you can do it. And most traders blow up their accounts. They try and they just lose all their money. And they don't manage their risk properly, and they don't even know what they're doing. So imagine trying to play golf in a PGA tournament when you're brand new at golf. And you put up the $5,000 and then you lose it. And that's not unexpected because you're playing against golfers that have played since they were 6 years old. and they're at the top of their game. So that's what the markets are. And most people think they can just go on the golf course and win a bunch of money, which of course is absurd. So, but there is a whole process to go through. Now, I'm going to give you an example of how you get better at trading. It's not a get-rich-quick thing. It's a get-rich-slowly thing. It's like any other business. You have to run it like a business. But okay, here's how I can explain it to you. So we all know what a light post looks like, right? A light post on the street, and we know what a telephone pole looks like. So the telephone poles are about 12 to 15 inches in diameter, and the light posts are about 5 or 6 inches in diameter. So imagine your job was to make the light post as thick as the telephone pole. In other words, you have to grow the diameter of that 5-inch pole to 15 inches or whatever that is. So obviously, you have to do it with paint, coats of paint. So obviously you're going to have to go out every day and put a coat of paint on, let it dry, come out the next day, put a coat of paint on. It's going to take a lot of time to keep putting those coats of paint on. But eventually, if you do enough of that, the size of the pole will get bigger and bigger as you put more coats of paint on. Eventually, you'll get to the point where you reach the telephone pole. But it's going to take time because you have to wait each day. You have to kind of go through the process. You have to paint. You'll get better at it, more efficient. What most people do is they go out to Home Depot, they buy a 5-gallon bucket of paint, and they throw it at the pole. And that doesn't do a whole lot, right? In fact, you waste your paint. That's what most traders do when they're new. So between the PGA golf course and throwing the bucket of paint, that's how trading works. It takes a lot of time to get better. The biggest part of it, and everybody has a different brain, is figuring out what you want to trade and then figure out how to overcome your personal obstacles. So let me give you an example of some of my obstacles. So, being nervous to pull the trigger for fear of losing money. That's one challenge that I've had. Another one is once you enter, is just sitting still and letting the trade play out instead of taking profits too quickly. So that's one of my challenges. And then the other challenge I've had is I try to watch too many things at once. I try to watch the futures market, 5 or 6 different stocks, some currencies. And eventually, you're looking around so much that you don't focus on something, and then you miss out on some opportunities that you would have taken if you've been watching one chart instead of 17. So that's just a discipline thing that I'm working for. So I'm working now with a mentor. It's a whole program. It's a 90-day program where you start out, you have a first meeting, you map out your goals, you figure out what you're going to do, you figure out what kind of accounts you're going to use, which instruments you're going to trade, what your setups are. And then you just practice and work with the mentor. So that's what I'm doing. I think it's interesting. Yeah, Patricia says I'm an index girl myself. Yeah, there's investing, and there's a big difference between long-term investing and trading. Investing is basically just putting stuff in there. And that works pretty well usually, by the way, because the market historically goes up about 8% a year over time. But it compounds, obviously. So the problem with buy and hold, though, is if you go through a longer-term bear market, right when you're getting ready to get out, when you have to retire and take money out, now you're having to sell stuff at a loss, which is no fun when the market's down. But as long as corporations keep, growing, and as long as profits keep growing and the economy keeps growing with more people, the markets will go up accordingly. So it's not a bad idea to invest. And trading and investing are different, and trading is basically used to generate short-term income. Investing is kind of wealth-oriented. So what most traders will do is they'll start out with a trading account of, let's just say $50,000, just to keep it simple. And what they'll do is they'll trade, and if they make $5,000 in a month, they'll just sweep that out of their account, and they'll usually buy stocks with that long-term account stuff. And so, my trading account is not that size, it's smaller. But there's the different things you can trade. You can trade stocks like we just talked about. And there are smaller stocks, which they call penny stocks, are usually from, 50 cents to $5. And then you have your mid cap and your large cap stocks. That's called capitalization. That's the number of shares times the price of each share. So a large cap stock would be like Amazon or Google or Microsoft or Apple, Nvidia, Taiwan Semiconductor, all these companies. These are all the ones that I follow. And they don't trade as quickly as the other ones do. They don't tend to appreciate huge. If you're trading a penny stock, it might be $1.25 a share when you try to get into it. It could go up to $2 in the same day. which is a huge percentage gain. It's like a 60 or 70% gain. You're not going to get that on Google. You might get 1% or 2% in a day if you're lucky. But you can use leverage. If you want to increase your return, you can use leverage. Options give you leverage. So if you want to buy a call option, that means you're hoping the stock, the underlying instrument, will go up in value, and your stock option increases with leverage. Or you can buy a put option, which means you think the price of the instrument is going to go down. So for example, you can buy Amazon puts, and if Amazon drops by $2, you're going to make more than $2 per share because the instrument is leveraged. But likewise, if you lose on that trade, you'll lose more as well. So this is a lot of stuff you have to learn. Then there are futures, which are index futures. You have commodity futures. You have gold. I track gold, oil, and the S&P 500 mostly for my index trades. So you can trade futures, and there's all sorts of other strategies to getting. You can do what are called cash secured puts, where you're selling puts below the market and hoping that it doesn't get hit. And if it does, you take assignment. Anyway, the bottom line with trading is it's a numbers game. We've all heard of like baseball. You've got the people that bat for the baseball, and if you're batting if you're hitting like 2.5 hits out of 10 or 3 hits out of 10, you're doing really well. And that's kind of how trading works. The goal in trading is to make sure that the trades you're in that do well make you more money than the ones where they don't do well. So that involves having risk management in place. So I'll give you a good example. So let's just say you have a $1,000 trading account, to keep it simple. And if you have more, you can just multiply it by whatever you have. Okay, so on every trade you take, you have to have a defined risk amount. So usually 1% of your trading account is a good barometer. Some people do more. But when you're getting started, 1%. So what's 10% of 1,000? $100, right? So what's 1/10 of that? $10. So 1% of $1,000 is $10. So the most you're going to risk per trade is $10 of your trading account. Now, how do you figure out what to do? Well, let's say you have a stock that's trading $50 a share, and you think it's going to go up a couple bucks. So you're willing to risk $1. In other words, if the stock goes down and hits $49, it does not go in the direction you hope, you're going to get out. That's called a stop. So you always put your stop a little bit below if you're going long, meaning you're buying, or a little bit above the price if you're going short. It's a protective order or a protective mental area that you're going to get out before you have too much damage to your account. Most new traders don't even do this. They just kind of get in and hope. That's a terrible strategy. So the reason you have the stop in place is because there's a key level. The last couple times prices come down, it stopped at 50, and you think it's going to bounce off 50, so you buy it at 50. But you say if it breaks that level, which is a key level where other banks and stuff have bought, you're going to get out because you don't want it to go down to 42 or 40, then you're losing a lot of money. And then what you do is you set a profit above it. And maybe the target is 2-to-1. So if you're risking $1, you want to make $2. Or generally speaking, you want to look at the chart and look to the left, meaning that you're going to look in the past and see at what level the banks or other big traders sold. Because people like you and me can't move the market. The big banks move the market. So let's say in the past, $54 was the last time where there was a lot of selling pressure. So maybe you'll try to make your target $53 because you don't want to get caught trying to sell at the time everybody else is. You're going to kind of front run it a little bit. So your trading plan is I'm going to buy at 50. I'm going to have a stop at 49, risking $1 per share. And I'm going to try to target $53 as my target, right? So it's a $3 win and a $1 loss. That's called your reward to risk ratio. The bigger you can make that, the better your trading will do. But not every chart will afford you that. So it's all chart dependent. And that's called technical analysis when you look at the price movement. So why do I tell you all this? So your win rate, the number of trades you win versus lose, and the risk reward ratio. In other words, if you're winning $3 every time you have a winning trade and you're losing $1 every time you lose a trade, that's good. And you only have to be right about 4 times out of 10 to make money with that system. So you can lose more trades than you win and still make money with that system, if you can believe it. So what you want to do is you want to trade a basket of trades, like 20 trades, and then see how you're doing after 20 trades. In this case, we have a $50 stock. We're only able to risk $10 per share. Well, if we have a $1,000 trading account, the most shares we can buy is 20, right? Because 20 times 50 is $1,000. So that's our capital limit. But we don't want to risk more than $10 on any one trade. So if we're risking $1 per share, and we don't want to lose more than $10 if our position goes against us, we can't buy any more than 10 shares. So we're going to use $500 of our account. We're going to buy 10 shares, and that's the trade we're going to take. Then, if it does dip to 49, we have an order that gets executed, and we lost $10. If it goes to 53, we have an order that gets executed, and we made $3. That's trading right there. That's all you got to do. And then you have to just kind of figure out, those are called, the way that you choose to get in and out are called setups. And you learn over time what is a valid setup and what isn't. And it's learning what not to do in many cases is what helps you get better, because then you're only taking the ones that make the most sense. Now, I talked about banks. If you ever get a chance to look at a chart of anything, you can look at crypto, you can look at any stock, you can look at any futures, doesn't really matter, currencies. There are always levels on the chart where you can see price was stopped moving up or stopped going down. And those are generally called areas of supply at the top and demand at the bottom, meaning that somebody wants to buy near a low, it's a bank, and they want to get out and sell near the highs. You know, we've all heard the adage, buy low, sell high, right? Well, that's what the banks do. The banks buy low and they sell high, and they wait for price to come back down to an area where they want to buy, and that's where they buy. As a trader, what you want to do is identify all that on the chart, and then you want to be like the bank. Hold on one sec. Sorry about that. So as a trader, all we're trying to do is to look at a chart, figure out where it's likely, nothing's guaranteed, likely that the stock will bounce higher or stop going higher because it's got a lot of selling pressure. And that's pretty easy to do after a while once you learn how to do charting. It's not hard. Now, the hard part is having the emotional control to actually do the right thing when you're supposed to. And that's why keeping your risk low is so important. Because when you risk more than you should, in other words, if you're ever in a trade and you're worried about it, like, oh my gosh, this is really, that you're risking too much money. Most of us wouldn't freak out over a $10 loss, right? I don't think so. Now, everybody's different. Some traders that I know, they risk $5,000 per trade because they have a $500,000 trading account. So for them, losing $1,000 relative to the capital they have is not that big a deal, right? They're comfortable with that. As your trading account grows, you're risking more money. So let's say you start out with $1,000, you make it up to $2,000. Well, now you're trading with a $20 loss threshold. You make it up to $5,000, you're trading with a $50 loss threshold. And there's going to come a point where you're going to be less comfortable with whatever that amount becomes. Let's say it turns into $100, and you're starting to think a lot like, wait a second, I don't want to lose $100. That's a lot of money. And you're going to start having emotional tension with those numbers. And for you, it may not be till you get to 1,000 or whatever. It's different for everybody. But that's one of the big things that every trader goes through is as you increase your size of your position sizes because you have more money to work with, you start to have emotional issues related to the money side of it. That's why they say it's better just to look at the chart and don't think about the money. Just the chart's going to do what it's going to do anyway, so the money's going to be what it is. So you have to figure out what are you willing to risk, and if you lose it, it's not that big a deal. And you should really only trade with money. The money you're going to trade with should be money that you don't care if you lose it. So if you can spare an extra $500 or $1,000, just assume it's going to be gone. Now you can trade in what's called a simulator when you first get started if you want to. It mimics what the actual market does, but it's not real money. It's like fake money. But you still follow the same system that I mentioned. You're going to risk 1% of your capital on one trade, and you're going to have targets that are either 2 or 3 times your risk based on the chart. And if the chart doesn't leave you much to work with, if there's not enough meat on the bone, so to speak, you don't take the trade because you don't want to make trades where you risk $1 to make $1. That doesn't work. You have to have a little extra on the winners. Now, every once in a while, what's going to happen is you're going to get into a trade just at the right time, just by sheer chance, and it's going to go further. So one of the techniques you can do is Because obviously if you always sell when it hits $3 higher, you're never going to make more than $3. So what some traders will do is when it reaches their first profit target, that $3 move, they'll sell half to 2/3 of their shares and they'll hold on to a little bit. And those are called runners. And so as long as you're above your entry price and it keeps going higher, just stay in it. And you can even draw a little line under the lows as it goes higher, like a staircase. And just when it breaks the staircase, get out. But until it breaks the staircase, hang on. That's what a lot of traders do. They'll take they'll take part of their position off when it reaches a target, and they'll leave some just in case the bus keeps going, because you never know when the bus is going to turn around. And what happens is most traders, they probably trade maybe 100 times a year, and 1 or 2 of their trades makes most of their money for the whole year. Because on those 1 or 2 trades you take, it just takes off. And you never know which one it's going to be or when it's going to happen, because the markets are very unpredictable. The only thing we can control in the markets is how much we risk and how we choose to enter. And then, of course, how we manage it once it's in. That's it. Everything else is outside the control. So, that's why you don't hold positions over the weekend. If you're trading, instruments that are leveraged, you hold them over the weekend and something happens news-wise and it can really affect your positions. So you're just trying to minimize your risk as much as you can. If you minimize your risk, what happens is your losers are limited and your gainers eventually start to go much further than, expected. It's the people that don't manage their risk and they take big losses on 1 or 2 particular trades because they just kind of hold it and hope. Which, by the way, thank God that's not one of my problems. I've never done that. I've been very, very, very risk averse. Too much so. But I just don't want to lose my trading account. I wanted to have my money to work with. So that's what I do. Somebody here says don't blatantly lie. That's coming from Fields of Aces. Anyway, I hope this isn't too boring for everybody. Because and by the way, Samira, get that shit out of here, Samira. I'm trying my best to do the best I can. Go fuck yourself. Excuse me for that. You got trolls in the comments. Anyway, so that's trading in a nutshell. It's all probability. So for example, let's say you take 10 trades under that exact same situation. And let's say you win half and you lose half. Right? So let's say you win. So you're winning, you made $3. So 5 trades times $3 of winnings is $15. And then 5 trades of losing $1 is $5. So you have to subtract your losses from your winners. So you have $15 of gains and you have $5 of losses. So you made $10 or an average of $1 per trade. That's your expected return per trade. And then what you do is if you have different types of approaches, you keep track of them in a spreadsheet. You tag them with whatever the particular situation was and time of day or type of trade you took. And then you look back and figure out which ones are making you the most money and which ones are costing you more money. And then you just basically work on getting better at the ones that work for you. And that increases your returns. That's trading. Now, that's a simplified version of it. There's all sorts of different techniques you can do to get income off of option sales. But basically, that's the bottom line. It's manage your risk. The returns will generally take care of themselves, if that makes sense. Okay, now, here's my number 1 piece of advice. You ready? Number 1 piece of advice. You don't want to start trying to make money at first. I know we just talked about making $3 for every $1. Let's say you have $100,000. You're thinking, oh my gosh, I can make $3,000. I could make $5,000 or $10,000. Don't think that way. That's like thinking you're going to enter a PGA golf tournament and go out and win first prize, and you've only played golf for a week and people have been playing for 25 years. It's not going to happen. So the best thing you can do is use the smallest size possible. Don't even risk $10 a trade. Risk $1 per trade, trying to make $3. Something where there's real money involved, but it's absolutely the smallest amount because you're going to lose as you learn. You're going to lose as you learn. Let me say that again. You are going to lose as you learn. The goal of trading when you get started is not to make money. Your goal is to establish a process that is repeatable, that you track and review, and you work on your issues as you go through this. So you'll figure out very quickly what you're comfortable with in terms of Do you want to trade stocks? Do you want to trade options on stocks? Do you want to trade futures? You'll find something that kind of fits your groove. Are you going to trade day trade? Are you going to trade quickly, like get in and out within a few minutes? That's called scalping. Are you going to hold something for part of the day? That's called intraday trading. Are you going to hold something for multiple days? That's called swing trading. Are you going to hold stuff for months on end? That's like a semi investment, or are you just going to buy and hold? Those are all the different sort of ways you can play the market. So you need to know your time frame. When can you do it? Obviously, if you work a full-time job, you can't trade intraday because the markets, depending upon where you live, the markets are open from 9:30 a.m. Eastern time until 4 p.m. That's the typical market where see the bell ring, the people go in that big room and they ring the bell. But other things trade different hours. Futures trade different hours. Crypto trades just in different hours. So you're not stuck having to trade during that time if you can't. But the bottom line is you want to try to start slowly and build some sort of skill set in a repeatable process where you log and track your results. Even if you're doing paper trading, if you're doing simulated trading, you have to do the same thing. You have to do it exactly as you would do it if you were going to do it in real life, and try to establish the same pattern. And then here's the thing. Once you establish a pattern that's repeatable, then all you have to do is start with whatever you're starting with. And as the account grows, you simply scale up your numbers. So let's say you start with that $1,000 and you're risking $10 a trade. And let's say you make it to $2,000. So now you can risk $20 per trade and you can make possibly, $60, and so on and so on. Like I said, some traders, I know a guy that makes $15 million a year doing this. And he does it exactly as I'm telling you right now. Same exact thing, no different. Every trader does some variation of this. No successful trader kind of just buys and just kind of takes big chances. It just doesn't happen. Because like I said, they've learned the hard way. And a lot of traders that are really talented human beings and they're good at this, kind of naturally, they have a knack for it. But every single one who had a knack for it, you get cocky. And let's say you have 5 or 6 trades in a row where you just win every time. You're like, damn, I'm so good at this, I'm the king. So you size up. I'm going to risk $100 this time, not just 10. That's when you lose the trade. And so you just wiped out all of your earnings for the past 2 months because you got cocky and took one thing too far, thinking you were the man or the woman. That's what people do in trading. So I'm just telling you, don't do that. If you get good at managing your risk, just being very disciplined, just listen, you're not going to go to the moon day one. You're going to have to build up. And so the number one thing is just be patient and accept that reality. It took me a long time to stop trying to shortcut that process because I didn't want to wait. I wanted to start making money sooner. I wanted to take more risk. And you learn the hard way. You lose money when you do that. It's just the way it is. So that's the best way I can describe it to you. And it just comes down to numbers. And after you track yourself for a while, you will realize what you're good at. You will realize what you're not good at. You'll identify your emotions that come into play. So one thing you're supposed to do at the end of each day is if you do trades, or even if you don't take any trades, but you just watch the market, you want to make notes. Okay, I saw this today. This is why I didn't take action. This is where I should have done something, but I didn't. I was distracted. I was feeling emotional. I was afraid to get, whatever it may be. You want to mark all that stuff down so you can identify your patterns. Maybe on Fridays, after you go back and review your data for 6 months, maybe Fridays are your worst days. Maybe the market doesn't give a whole lot in Friday afternoons because most of those rich people go to the Hamptons, and you're trying to place a bunch of trades Friday afternoon to make money. You're caught in these choppy environments where you just don't make anything. And maybe on Mondays, when the market's really good, you're too tentative to take trades because there's too much volatility and you're missing out on huge opportunities or whatever, that kind of stuff. And eventually you recognize your shortcomings, you write them down, and you work on overcoming them. You're going to find that once you figure out the nuts and bolts, like you understand what you're going to trade, when you're going to trade it, what your position sizes are going to be, and you're good at managing the entries and exits of that, now you're going to start realizing your emotions. And the emotions are what dictate about 95% of your success. The best traders in the world, they have the same exact emotions that you and I do. All they do is they learn to recognize those feelings and they learn to act despite those feelings because they know based on their system they've analyzed it's the right thing to do, and that's why they make the money. Most new people, myself included, you wait until something turns green or starts to go up before you want to buy it. You want to have that certainty it's going to go up. And so you wait, and all the professional traders are already in. They took that chance when it wasn't clear, knowing that their system tells them to. And then what happens is that they're getting ready to exit their position for a profit, and guess who's buying? You and me, because we wanted to wait to get that confirmation. So almost always the professional traders are exiting the market when the people like you and I, they call the retail traders, are getting in. And same thing, when we're getting out in a panic, they're buying. And they say that the bottom line is most good traders are taking advantage of newer traders' bad decisions. And all the market is more experienced people taking money from less experienced people. That's all it is. It's a zero-sum game. For every trade on one side, there's someone on the other side that's either winning or losing. So initially, you're probably going to be transferring your money to the winning traders. And they say that there's only two kinds of traders, ones that withdraw money from their account and ones that have to add money back in, make deposits. So the goal is to get away from being somebody that has to keep refunding your account and be somebody who can take money out as you make money. So that's trading in a nutshell. I hope that makes some sense to people. Do me a favor, if there's any questions or that did not make sense, can you type the number 1 so I can try to go over some other stuff? Because I know this is a lot of information to take in. And thanks for the gifts, by the way. I don't know what they mean, but thank you for them, James. Yeah, this is different stuff. I normally talk about politics, but this is something that has my interest. I've been following the markets for, like 25 years, but I've never really applied myself to this process, which I'm working on right now. So, I'm in the same bucket as anybody else trying to go ahead. Okay, so Veronica, we were talking about the markets and how you become a successful trader. And it all comes down to, managing risk. The best traders in the world figure out ways not to lose very much when they have a position that goes against them. They say in trading, the best loser wins. What does that mean? The idea is to cut your losses quickly. So let's say you buy a stock for $50 and you're hoping it'll go to $55 over the next few months or weeks. Who knows? But $50 was the place that big banks bought it the last couple times. You've noticed on the chart, every time it comes down to $50, it goes back higher. So you're like, okay, I'll buy it at 50. Maybe that's what's going to happen this time. So you buy it at 50. And unfortunately, in this case, it runs down to $46. Now you've lost $4 a share, and that's not good. So what traders are supposed to do is to set what's called a stop loss, a protective stop. And that's an order you place either in your head, you can execute it if you see the thing happen, or you can actually put an order in the market that sits there until it gets canceled that says if the stock drops to $49, meaning you're only going to lose $1 a share, you want to get out. That's cutting your losers quickly. Now, what you don't want to do is if the stock moves down just below 50, down to $49.70, get out because of fear. Like, oh my God, it's going to hit my stop. You have to wait and be patient. Because once you set the trade in place and you know it's the right kind of thing for your system, you have to let it play out. You have to give it the wiggle room to do what it's going to do. And of course, if it breaks $50 and goes to $49, you get stopped out, so you lose $1 a share. No big deal. Wait for the next trade. And let's say the next time you do a trade, you're trading a stock that's trading at $60, like Coca-Cola or whatever. And so the last time it came down to 60, the bank stepped in and bought. So next time it drops to around 60, you buy it. And in this case, let's say it needs a little more wiggle room, so you put your stop in at $58 because that's the wiggle room it needs, so you don't get, because the buying prices were between 58 and 60 when the banks were stepping in. So you set a stop at $58, you buy it at 60, you're risking $2 a share. You buy whatever shares you can afford for your maximum loss, and you set a target, usually 2 to 3 times your risk amount. So you're trying to make it to $55, $57. That's trading. And then either one of two things happen. Either it hits your stop and you lose the $2 per share, or it runs to your target and you make the $5 or $6 a share. That's it. That's all you got to do. And you do that over and over. It's kind of boring after a while because there's no excitement to it. And especially if you're only risking a small amount of your trading capital, it's insignificant when you have a loss. It doesn't make you stay up at night worrying about the trade. The first time you start to feel discomfort with the amount of money you're risking too much. And you got to go back. So that's what trading is. And then all you do is compare your numbers. You go through and you keep a log of all the things you do. And over time, you're probably going to lose money when you first get started because there's so much kind of information you got to cover. But what you're going to learn to do is what not to do. And what happens is eventually when you see all the mistakes you make and you know what not to do, you end up only doing what you're supposed to do. And sometimes you miss out if you're distracted or just, didn't take the risk. But most of the time you stop making dumb mistakes and then your trades start to work more. That's trading. But it takes time. It takes the average trader between 3 and 5 years to get proficient. Ridiculous, I have no idea what you're talking about, but that's silliness. So that's how it works now. If you want to get started with trading, if you're somebody who wants to try this out, first of all, if you want me to, do me a favor, if you want me to talk more about this and maybe hold some lives with some examples with charts and stuff, do me a favor, type the number 1 in the chat if you'd like to see more of this content. Because I like talking about this as much as I like talking about politics. And let's face it, I've kind of been squeezed out of the community when it comes to Palestine. So maybe we'll just talk about this from now on. Yeah, cool. Okay, we've got some people that are interested. Okay, so let's say you wanted to get started with trading. So the way that trading works is you have to first have a brokerage account. A brokerage account. You've heard of Webull. You may have heard of, what's it called? What's that stupid one called? Robinhood. You've probably heard of TD Ameritrade or that. You've probably heard of Fidelity Investments. It doesn't matter where you open up your account, but it does depend on what kind of trading you want to do. If you're someone that wants to trade the really fast-moving penny stocks, you have to get a special broker that can execute trades faster. But I don't recommend you start with that. That's more of an advanced skill with hotkeys. So you can get an account at Fidelity, Schwab. I use a software called Thinkorswim, which is by TD Ameritrade. And they got bought by Schwab, so I have to, soon it's going to be changing over just to Charles Schwab. But it's a great piece of software to set up your charting. It doesn't really matter which broker you use, but what happens is you have to have a broker to execute your trades. So generally speaking, you need to have charting and you need to have data to feed the charts that come from the different exchanges. And then you need to have a broker where you can execute your orders. The way this works is some brokers offer charting software that comes as one package. So for example, when you go to TD Ameritrade, you get Thinkorswim, they will execute your trades for them. They have a brokerage tied in with the charts. Other charting software like TradingView, which is a very popular web-based program, they don't have a built-in brokerage. You can attach outside brokerage so you can trade from within TradingView and all the orders go to the broker of choice. And there's a list you can look at, different ones. It depends if you're trading futures or stocks or both. So, some of the more popular Interactive Brokers is one that's very popular with experienced traders. Fidelity, Charles Schwab, you've heard of E-Trade, things like that. Every broker has pros and cons. So you're going to have commissions on your non-equity trades. Most equity trades, which is stocks, are now commission free. But, and this is a big but, the reason why they're free is because the data from the brokerage goes to other institutional firms. It's called payment for order flow. And they can see, we talked about a stop loss order earlier today. We talked about, let's say you're going to buy that share for $60 and you're going to put your stop at 58. If you have that order in their system, other banks can see that order. So what do? They'll run the price down into your level to take out your stop, where they can buy your shares on the cheap, knowing it's going to go higher. And that's called a stop raid or liquidity hunting. It happens all the time. In fact, one of my trading strategies is to take advantage of that. It's like when a level breaks very quickly, but then price goes right back up through it the other way. That's what that is. That's when someone's basically using that order flow info. So it's not free in that someone else gets to see something that you don't for you getting the free trades. But it's still not a bad deal. You can buy 5,000 shares of any stock and they're not going to charge you a penny. It used to be the commissions used to be a big amount of trading. Now, if you trade futures or options, you're going to have to pay commissions on those. They're exchange fees as well as broker commissions. But either way, if you want to start out really simply, this is my advice to anybody. Open an account at like Webull, Webull. They have charting and they have the executions. It's a broker. Very simple, easy charting software. Go to Webull. You're going to trade one symbol only. One symbol only. It's very simple. Okay, I'm sure you've heard of the index called the S&P 500. Okay? Well, Ethio Gallery, if you don't need this, that's okay. We're just talking about this for others. So if you're not interested in this, you can come back later. I talk about other stuff too. But if you're somebody who already knows all this stuff, good for you. There are a lot of people here that don't, which is why I'm sharing this. So what I would suggest anybody who's new do is just keep it super, super simple. So for example, there is a 3-letter ticker that tracks the S&P 500. It's what's called an exchange traded fund. It's letters SPY, like the spider. S&P 500. Open a brokerage, pull up that ticker, and only trade that ticker. Just get used to the charting, see how the movement is, look at the levels, and just trade that. Trade one share at a time. And this is not financial advice because I don't know how much money you have. I don't know what it fits in. But if you're going to just try this for kicks and grins, open up a Webull account or whatever you like, trade SPY, and get used to the process I've been talking about. Just do that. Trade one share at a time. That will limit your risk to almost nothing. And then set those same parameters. Let's say I'm going to get in at 400, which is about what it's trading at now, I guess, or something like that. And you're going to get out if it goes to 398, and you're going to try to make it go to 405 or something like that. And that way you're going to lose, $2 at the worst if the trade goes against you. That's nothing, right? And just get used to that. Get used to that process. Well, there's all sorts of brokers. You can go onto Google and type in, best broker for new traders or something like that. I recommend Webull because I have Webull. I don't have it funded right now, but it's very easy to use. It's got a very simple order interface. Doesn't cost anything, and the commissions are free, so you won't get hit by commissions. But when I say trade one share, trust me, trade one share. While you learn what you're doing, trade one share. The reason I don't recommend simulated accounts, you can do it. The first time you use software to get the hang of where the buttons are, you can use a demo account because it's better than making mistakes with order execution. So to get used to the platform, like trying to learn how to fly the airplane, use the demo account. The problem with the demo accounts is when you go to buy or sell something in the real market, the fills, the actual completion of the orders is way different than in the simulator. You'll notice that sometimes when you try to buy something in a simulator, you get it. When you try to buy it in the real market, you don't get it because you're getting real price movement. So that's what I would suggest. I wish I would have done that. I would have saved myself a good bit of money if I would be following this advice. And this is the thing that no trader wants to hear. New trader, you want to make money, right? Oh, I want to go in and make $1,000. I want to make $5,000. I want to make $20,000. You're going to lose the amounts you say you want. Just trust me, you're going to lose all your money. The more risk you take initially, you're going to lose whatever you risk. Just take my word for it. I wouldn't lie to you. I tell the truth. So that's why it's best to start really small. And this is not for everybody, by the way. It's like the emotional Olympics. Trading requires discipline, some level of intelligence, but not crazy amounts, consistency, and putting in the work. What do I mean by the work? Well, you have to, before the market opens each day, you have to prepare and see what's potentially happening with earnings reports or, the stocks, like what's happened overnight, what happened in the Asian session. Look at the potential areas of support and resistance on the charts or supply and demand, and then look at what might happen. It's all about sort of having a game plan before the market. That's work. I start mine at 7:30 a.m. and I do it until about 9:30. So 2 hours a morning of preparation. Then the market opens at 9:30. I trade till 11:30. So that's 2 hours of actual trading. Then the market slows down a little bit, lunchtime till about 2 o'clock, 2:30, and then it picks back up again until it closes at 4. So I generally don't trade the afternoons that much unless something's really moving, like if something's crazy's happening or some company shut down and it's either going way down or going way up. Then I'll trade it. But most time the mornings are the best time because you have the overlap between the Europeans and the Americans. All the traders are in, so you get a lot of movement, a lot of liquidity, a lot of price movement, and therefore you get volatility. And that's where you make your money, when things start to move. When things are slow, like in the afternoon, it's kind of chopping around, it's the worst time to trade. So during lunchtime, when things kind of get choppy, and during the afternoons, it's just not the right time. You need movement. It's like, imagine if you're trying to go sailing and you're on a lake and there's just no wind. You're just sitting there like looking at each other like, why are we here? That's how trading gets most days during those dead times. Not every day. And some days you'll find yourself staying at the computer because... Now, let's say you're somebody who doesn't have time to sit at the computer during the day. Well, you can look at the market after it closes, which is what I do every night. I spend about an hour and a half every night. Once the market closes, I review the charts, I update the levels, and I probably follow, let me think, I probably follow like 20 symbols. That's it. I follow some futures. I follow most of the big stocks like Amazon and Google and Tesla. Now, Tesla just had earnings yesterday after the market closed, and it jumped about 6% off the lows, but it went right up into a level that it had crashed through earlier. So it's stuck. Tesla's not doing well. So, but you'll learn all this stuff. Earnings is, if you know a stock is about to have earnings and you're in the stock, it's better to close it out, because no one knows what's going to happen on the earnings report unless you're an insider. But even then, you don't know how the market's going to react. So earnings is like flipping a coin. We don't want to flip a coin. We want to have an edge. And the edge that we have eventually, you know what it is? The edge that you develop as a trader is knowing the things to do that the new person doesn't. Getting in when you should, when someone else is panicking out, and getting your stuff out to somebody when they're chasing it higher. That's basically the market. And I can draw, if I drew you a picture right now and said, just follow this picture, you'd be successful. It's not easy to do, but it shows you exactly what something should look like when you're going to get in or get out. It's a very simple curve. And what I do is I have that in front of my desk, and I always look at the chart before I'm about to get into a trade. I say, does it look like this curve? Yes or no? If it doesn't, I don't get in. That's it. So, hey, Badiah, I appreciate your suggestions, but I kind of cover what I want to cover in these lives, and if it doesn't appeal to somebody at that time, they can switch over to someone else's. There are a lot of Israel-Palestine lives right now probably going on, which you can check out if that's the subject you want to see. I'm just talking about trading today because, quite frankly, I'm a little bit soured by the community and how all this stuff is played out, and that's, the whole thing is just sort of, it's been a big turnoff from that generation, so... Anyway, it is. But no, if you want to watch that kind of stuff, Badiah, go ahead and flip around. So we're not going to talk about that today. Okay, so if anybody's interested in trying to do this, I'm trying to get an idea of how many people might want to do this, if I should keep talking or not about this subject. So if you're somebody that's interested in learning more about this, or you're interested in I make no money. This is not something to try to, I'm not going to make money off of teaching you this stuff. There's no financial gain in this for me. I just talk about it because I find it interesting. But if you're somebody who's interested, do me a favor. If you're interested in starting doing it, or you have an interest in learning more, type the number 1 in the chat. And if I don't see many ones, I just won't keep talking about this. Okay, yeah, Steve says he likes QQQ. Okay, we got a bunch of people saying 1, good. Steve says Steve is there, good. And listen, I love teaching, and I think that I can save people a lot of toil and a lot of emotional heartache. I think, unfortunately, most of the people that are on TikTok that talk about trading, they don't tell you this part of it. They start going over charts, and they get into the advanced mode stuff. They don't teach you the basics. And the basics are the most important thing. And you have to... The most important thing are setting your expectations. You wouldn't go out on an NBA basketball court and expect to make three-pointers and make layups on LeBron James. And you wouldn't go out on a golf tournament and expect to beat Scottie Scheffler, the number 1 player, or Tiger Woods, right? Well, then why would you enter the market and expect to make a ton of money against people who are similar to LeBron James and Tiger Woods, right? It's just ludicrous. So what you do is you learn over time how to do things better by practice, just like they did dribbling drills, or they practiced their putting, or they practiced their swinging. That's what you and I do. We're going to practice, and we're never going to be as good as Tiger Woods, right? But you don't have to be, because to make money in the markets, all you have to do is make more on your winning trades than you lose on your losing trades. We can control our losers every single time. That's the good news. Nobody can force you not to lose money. So as long as you have tight risk management, and what that involves is getting in at the edges of moves. So once you identify an area where previous buying has taken place, that's where you put your order. And usually your order gets filled. You bid to buy at a certain price. Your order gets filled. You have your stop below the area where buying has taken place in case it keeps going down. And likewise, you put your sell order higher where the previous selling has taken place. And like Steve just said, you buy low and you sell high. That's how you do it. Now, it's easier said than done, trust me, because you never know when it's coming down into a level if it's going to stop there or not. And there's a certain feeling in your gut that goes, well, I'm not really sure it's going to stop there. That's what you got to overcome. You got to just stick your order there and let it fill and see what happens. And if you do that enough times in the right spots on the chart, you can minimize your risk because you're very close to the place where you figure out very quickly if the thing's not going to work or not. The further away you get from the edges, the more you have to risk because it's moved. And most traders wait too long. They want to see confirmation, but by the time you get your confirmation, it's expensive because you have to risk more money in order to continue the trade. And that'll all make sense if I go through some charts. And I'm not a TikTok expert, so I'm going to have to do this with my phone. I don't know how to even bring up stuff in the background that's chart driven. The other thing I notice is a lot of teachers who teach stock trading, they show you the entire chart after the move is played out to teach you. That's ridiculous. You never get to see what happens in the future. You only get to see what's happening now, right? The hard right edge. You don't get to see into the future. Why would you teach somebody on a chart what to look for after the thing's already done? Your brain, you'll never match your pre-trade learning with looking at something after it happens. That drives me crazy. So one thing I'm going to do is I'm going to teach people from the hard right edge of the chart. And when I say hard, it is difficult. Now, by the way, trading is one of the hardest things you'll probably ever try to do. So just set your expectations very low. Don't beat yourself up. It's going to be very hard to do. But if you take the time to get good at it, you give of yourself. You just let go of your expectations, give of yourself to a process, accept that it's going to take some time to build a skill set, get the education you need, practice, practice, practice. Eventually, you will turn the corner if you follow the systems. Most people don't want to do the work, myself included. I tried to skip this work. I tried to get to the front of the line. I tried to take on Tiger Woods. Guess what? I lost, as you would too. The people that do well with this are humble enough, which I certainly wasn't, to accept the fact that you can't throw the 5-gallon can of paint at the light post to make it get as big as a telephone pole. You have to put the one coat of paint on one day at a time. It's going to take you, if you're lucky, 6 months to get really good. If you're average, probably 2 years, maybe 3 years. And you can do this in your spare time. You don't have to do it during the day. Just remember that it's the number of instances that you get in and out of the market that build your skill set. So if you're someone who's trading daytime, you'll get more trades in, and your learning curve from a calendar perspective will be more narrow. If you only trade a couple times a week, because you're looking at the charts after hours or maybe once a month, it's going to take you a lot longer from a calendar perspective to become proficient. Does that make sense? I hope that makes sense. All right, I got to start heading back. I got a meeting at 1 o'clock I got to go to. So, all right, so interesting. So one of the things you never want to do is buy at the highs and sell at the lows. And a lot of people do that because they panic. And for example, when Bitcoin started to go up recently, it got up to like over 70,000. A lot of people bought in, like, oh my God, it's going to keep going. They get what's called FOMO, fear of missing out. Whenever you start to feel that feeling of like, oh my gosh, I better get in because don't get in. That's a guaranteed thing when not to get in. When you feel the most nervous, when something's going down and you start to feel that really scared feeling, that is the best time not to sell. Because guess what? Everybody else feels that same feeling that you're feeling. And as traders, what we have to do is learn to do certain things despite the way we feel. It's like counterintuitive. Trading is doing everything the exact opposite of how your natural feelings are. It's very, very strange. By the way, can anybody hear me? I'm not seeing any more comments come through. If you can hear me, can you please let me know you can hear me? Because I'm not seeing any comments come in. Maybe the live locked up or something. Okay, good. Steve can hear me. So it's a very strange game. It will cause you more emotional distress than almost anything you've ever tried to do. But the most important thing, it'll cause you less stress if you risk less money. Trust me. Now, one of the things I can tell you that I don't like to do, I don't like to track my trades. I mean, it's easy enough to load them into a tracking system, but to get better, what a trader has to do is to review what happened in the market that day or that week, whenever you're doing it, and then reflect on some of the things we've been talking about, mistakes that are made, emotional feelings, and you got to write it down and you got to journal. And by doing all this, you identify what works, what doesn't work, and what your emotions are throughout these processes. And then you just have to agree not to make the same mistake again. So if you bought the highs one time and you FOMO'd in, basically were chasing it, and you lost money, you make a note, don't chase. And then you put that next to your monitor, don't chase. And if you sold in a panic one time near the lows, you put down, don't panic sell. And don't do it again. So that's how you build your skill set. And then eventually your system, you don't have to trade like 50 different stocks and be like the master spinning 10 plates at once. You can do that if you're good at it. I find that very deep. I'm not good at that. But all you have to do is pick one symbol and start applying your money to it. And as you make more money, you just up your size and do the same thing over and over again. I know traders that only do one thing. They have one pattern they trade. That's it, one pattern. And they wait for it to set up. And if it doesn't set up, they don't do anything. And they wait, and they wait, and they wait. And then when it does set up, boom, they go in. And if it works, it works. If it doesn't, it doesn't. It's a very simple approach. Now, they risk a lot more money on one thing. I know a guy that risks $50,000 a trade. But he's really good. He probably is right 8 times out of 10. And he makes a lot of money. He made $17 million last year. It's a lot of money. Now, not many traders make that kind of money because it's hard to put that much money to work in certain markets. There's a limit to, especially when it comes to stocks or options, some of the shares you can get at the right price. But usually with futures, there's plenty of liquidity for that type of size account. So the key is, if you want to get started, there's plenty of resources on YouTube about the basics of how the probability works and some of the strategies you can use. There's all sorts of strategies. There's strategies that go long, which means you're a buyer. There's strategies where you learn to go short, which means you're a seller. And the way the markets work, all shorting is, people get really nervous. Oh my God, shorting is so risky. It's not risky at all. Shorting means that you sell something at the high first, and then you're responsible for buying it back later at a lower price. You make the difference in the money. Whereas when you buy something, you buy the low, and then you sell it at the highs if it goes up. So shorting is just the exact opposite. Now with stocks, it's a little different because you have to borrow the shares from your broker. So for big companies like IBM or Google, they have tons of shares in their inventory, so you can borrow shares very easily. But for small stocks like XYZL or something like that, there may not be shares available for borrowing. So it's a whole nother thing. But that's getting into the weeds. Hello. Pretty dog. So yeah, there's a lot to learn, but again, once you get good at one little thing on one ticker, you can then expand your horizon and you can learn to do more than one. I suggest going to a second one. Don't make it complicated. If you get good at doing 2, then add a third. And if you get good at doing 3 tickers at once, then you can pretty much figure out which other ones. How's it going? You can pretty much figure out whatever you want to do at that point, because now you can manage 3 at once, and that's pretty good. So, in your first year of trading, let's say you have $500 to trade with. My suggestion is that you only lose $50 of that trading account at the most. And if you lose 50, you stop trading with real money. That means you can only lose 10% of your account. And that's a hard and fast rule. Now, most traders have rules during a particular day or a week or a month as to what their maximum drawdown is. And by limiting your risk and limiting your drawdowns and refocusing yourself you can stay alive to trade again. If you lose your account, you have to start over, and then you have to get the money back, which is what most people do. Somebody sent me a message on TikTok last night saying that they've been trading Forex, which is a whole nother market. That's the currency exchange markets. And that is the worst place for a new trader to trade. In fact, most traders fail, but in the Forex market, you're trading against the best of the best of the best in the banking system. And those traders are ridiculous. Plus now you have computerized trading. There's just no way to win at Forex. You can, but it's very rare that somebody is a winning trader in Forex. So avoid the Forex market. And I'd avoid crypto as well too if you're new. Just trade the SPY symbol. Every broker has it. It's very simple. Can't lose much money doing it. And learn. So that's all I got for you all today. But I'll tell you what, if you want to do another one of these, I'll get my computer up and we can start looking at some charts. And we'll go from there. So if you would like that, if you want me to show you some chart examples of the kind of things that I do, it's very simple, obviously. So yeah, we'll talk about it some more. Okay, I'm gonna close it out for now. I'll put this up on the internet, and I'll just put a little tag on this. We talked about trading. Okay, everybody. Also, I'll be talking about some politics stuff too. I just needed to take a break for a bit. Okay. So I'll see you later, everybody. Thanks for being here.